Welcome. This is Bruce Booth, one of the partners at LifeSciVC, and I am here to share the 2024 Atlas Year in Review. It's hard to believe we've been giving this presentation for over 10 years. In thinking about content for this year's presentation, I went back and read lots of the prior material and was struck by the similarity of many of the themes. On the science and medicine front, we started off talking about the opportunities in obesity and Alzheimer's and computer-aided drug design. We talked about the decade of immunology, new modalities, gene therapies curing, and of course, the big impacts more recently in things like obesity and Alzheimer's. On the investment climate, the themes, of course, trace the capital markets. Things opened up in 2013 and 14. They got a little frothy in 15 before resetting. Same thing happened through 2018 and a bit of a reset. And then, of course, the run-up into the pandemic bubble and, of course, the retrenchment ever since. On the policy side, the big theme across all of this, the perennial issue, was, of course, always drug pricing. Drug pricing and, in particular, the social contract. Of course, we also touched on things like the FDA, the FTC, and more recently, interest rates. The point of all this was a bit of Groundhog Day. Similar themes, just different years. The reality is the industry is not a jet ski, it's an aircraft carrier, and it can't pivot to new hot topics in a few short years. And I use this as a disclaimer to say that I'm going to cover some well-trodden themes in this year's year in review, and hopefully can provide a fresh perspective to those. And so we're going to cover three things as always. We're going to start with innovation and impact. We're going to then go into the investment climate, and then a brief update on LifeSciVC. So starting off on innovation and impact, I asked ChatGPT to help us with a word cloud for the 50 most interesting words to describe the biopharma sector this year. These are a number of those words. We're going to cover a bit of the investment themes on here later on in the next section, but I'd like to start with really a deep dive on 6 major issues, starting with obesity. So if we look at obesity and we take a flashback to 2014, 2 out of every 5 Americans were obese, and there was really no commercial opportunity. 4 approved drugs led to clinically insignificant weight loss with really troubling side effect profiles. Jumping forward to today, again, 2 out of 5 Americans remain obese. We may have even come down off of peak obesity, but the market has exploded. 2 active drugs, semaglutide and tirzepatide, have led to profound overall weight loss and have really opened up this opportunity, so much so that analysts forecast this to be the largest drug class in the history of the industry, likely topping $120 billion by the start of the next decade. That's going from 0 to $120 billion in less than 10 years. Now, this hasn't been driven by just aesthetic and cosmetic weight loss. In fact, there's a huge number of health benefits. If we start off with kidney disease, a real reduction in adverse kidney events. In MASH and liver disease, a resolution of fatty liver, a resolution of fibrosis. In obesity-related cancers, we're seeing a reduction in the incidence of these cancers like colorectal. In heart failure, an improvement in heart function and a reduction in cardiac disorder, a reduction in strokes, in heart attacks, a reduction in the progression from prediabetes to diabetes by 94%, the resolution of sleep apnea in 50% of patients, and in diseases of inflammation that are comorbid with obesity like asthma, psoriasis, and HS, some real exciting early signals. Earlier this week, we saw osteoarthritis. And then, last but not least, in Alzheimer's, a huge observational study suggests a reduction in the risk of progression to Alzheimer's. And importantly, a treatment study underway right now will report out next year on whether these drugs can actually affect Alzheimer's as a disease and cognition. So it's fair to say that the pleiotropic consequences of reducing obesity and related systemic inflammation has enormous health benefits and likely the biggest health outcomes of any medicine in our lifetimes. All of this excitement has, of course, led to a huge burgeoning pipeline and a set of R&D activities across the industry. There's over 75 drugs currently in clinical development targeting obesity, the vast majority of which are in the incretin or established classes. We've participated at Atlas in a couple ways in this space. The first was at Versanis with bimagrumab, an antibody targeting the activin receptor, leading to a muscle-sparing approach to obesity that Eli Lilly picked up last year. And then more recently, with our partners at Hengrui, their whole GLP portfolio moving into a startup called Kylera that just launched earlier this year. With this much R&D activity and these kinds of massive health benefits, this is a class that's going to reshape the pharmaceutical sector. It's hard to think of another drug class with this kind of impact, but perhaps the closest parallel is the statin class. Discovered in the 1970s, there were early launches in 1987, 1989 by Merck with Mevacor and Zocor, followed by BMS with Pravachol, Novartis with Lescol. Importantly, these established this as a multi-blockbuster class. Late entrants, like Pfizer's Lipitor and AZ's Crestor, actually ended up taking large chunks, if not the majority, of the value in this class, with best-in-class target product profiles. The class also had lots of exuberance about the pleiotropic effects of statins. Studies were done in cancer and Alzheimer's, which unfortunately did not have more than marginal impacts. The whole class evolved towards combination therapies and then new mechanisms of action to complement the statins, like PCSK9. But fundamentally, over this period of time, it was hard for pharma companies not to be in the class. This was a major growth driver for the sector, and if you weren't in this class, you were going to fall behind. We see the GLP-1 class very much in the same way. Novo and Lilly have first-mover advantages here, but there are a lot of pharma companies right on their tails, as well as biotech companies. You see Amgen, AstraZeneca, Roche, Merck, many other companies investing in this space. I think Big Pharma will have to participate in some way in the metabolic and obesity revolution that we are in the early innings of. Besides reshaping the pharma industry, it's also reshaping society. Take the beverage and food industry. Analysts call it the snackpocalypse. Just this year alone, $6 billion reduction in processed food consumption, likely attributed to GLP-1s. It's changing countries. 50% of GDP growth in Denmark is driven by one active ingredient, semaglutide. The market cap of Novo is actually bigger than the GDP of the country. And the company that owns Novo, the Novo Foundation, is now the largest charity in the world. It's also reshaping employment and HR benefits in the United States. Access to GLP-1s is either keeping people in their jobs or having them move to be able to get access. It is the number one HR benefit, even above unlimited paid time off. And then lastly, it's reshaping telehealth, direct consumer distribution, and of course the rise of compounding pharmacies. I think when the dust settles on all the lawsuits and where this ends up, it will have really shaken up the commercialization and distribution models in our sector. And so that's a wrap on obesity and its tremendous impact. China is the second topic I want to cover. Again, flashback to a decade ago, China was really a low-cost, high-quality partner for Western pharmaceutical companies and biotechs. Most of our discovery stage companies partnered with different discovery organizations, many of which are on the right-hand side here. They were great partners. They're manufacturing partners, helping with GMP processes and such. And of course, it was an emerging global pharmaceutical market. But today, China is the source of innovation of patented global medicines. It is also home to lots of global players, including aspiring biotechs like BeiGene, and is now a huge market, the second largest pharmaceutical market in the world. Getting access to innovation from China is critical for Western companies, and so we're seeing a huge number of China to the West licensing and partnership deals. Here's a set of oncology deals that have been done. Carvykti, the approved drug from Legend and J&J, came from this collaboration. More recently, Summit and Akeso published data with their bispecific hitting both PD-1 and VEGF, where it beat Keytruda in lung cancer. So real innovations coming out in the cancer space through deals with China, but also in other disease areas, in autoimmune disease, cardiometabolic disease, and elsewhere. We participated again with Hengrui at both Kylera, but also at Ilos, working in the TSLP space. But all is not great in China. In fact, quality and manufacturing issues continue to plague the expansion of manufacturing and lab quality over in China. We're also seeing the impacts of biosecure, preventing companies in the U.S. from working with some of our established partners in China. Of course, there's geopolitical tensions and the threat of military conflict, in particular in the South China Sea. And then more recently, the source of capital for lots of early-stage innovation in China has dropped off precipitously. Venture capital funding in China is down some 90% in the last couple years. All in all, lots of dynamism in the relationship with China and lots of activity across the industry. Another area with a lot of activity has been immunology. We talked in prior year in reviews about the decade of immunology that we were embarking on. Well, it appears like we are in decades of immunology at this point. Huge number of interesting targets that have the potential to be pipeline in a product. 24 of these targets have over 10 development stage programs across the industry. So a huge amount of crowding and competitive intensity to go after these products that are going to have a multitude of underlying indications. In addition to being expensive, these have great commercial prospects, which is why a huge amount of autoimmune disease M&A, product-focused M&A, has been happening over the last 2 years. Over $40 billion of M&A. Atlas has been fortunate to participate with Nimbus with the TYK2 inhibitor in the acquisition by Takeda, and again at Ilos with our TSLP program in GSK. Some of the areas that remain hot in the autoimmune space for investors today: applying the lessons of CAR T from cancer into lupus, being able to deplete those B cells. Also T cell depletion, looking at the role of T cells in specific areas. The idea of taking existing targets, well-precedented targets where there's antibody drugs, and making really long half-life or differentiated versions of those is also an area of potentially low-risk investment on the part of many investors. STAT6 orals, this is one of the really hard-to-drug targets in immunology, is starting to crack. We're very proud at Kymera to be the first company to take a STAT6 oral drug, a degrader, into the clinic just recently. There are a number of other STAT6 programs across the industry and in the Atlas portfolio that are moving right behind them. And then bispecifics that can take different cytokines, different receptor pathways, and combine those with synergistic effects. These are all great areas for investor interest today. But another area of great investor interest has, of course, been AI and machine learning. There's been an incredible amount of buzz and hype in this space. It's been difficult to figure out where the reality is. In what is probably one of the most aspirational quotes from an AI machine learning biotech company back in 2014, Recursion said they wanted 100 clinical programs in 10 years. Unfortunately, they missed that. They have 5 clinical programs. And while I say that, it's important to know that any biotech company that's just 10 years old that has 5 drugs in the clinic is actually incredibly productive. So this gets at the concept of separating hype from reality, because the reality is there. AI and machine learning will have targeted impacts up and down the R&D process. In drug discovery, things like AlphaFold helping us predict protein structure, of course the subject of a Nobel Prize. In the areas of preclinical development, being able to predict toxicities or create better routes for manufacturing drugs. And then in the clinic, being able to help with patient selection, that critically important issue of enrollment into clinical trials. And then up and down this spectrum, helping us with regulatory documentation and the writing of those, an obvious area for large language models. But fundamentally, in the drug R&D space, given the complexity of human biology and the lack of massive data sets, we think that the impact of AI and machine learning on R&D is going to be more likely around evolution than revolution. We're not going to see drug discovery go from a multi-year process to just weeks or days. AI and machine learning remains a super dynamic space, and one in which all of us have to continue to watch for advancements. Another area that's been dynamic has been in the field of oncology. A decade ago, immuno-oncology was really born with the excitement around the PD-1 programs. Ira Mellman wrote a great review, came up with this immuno-oncology cycle that became a staple in nearly every pitch deck we saw for multiple years. Unfortunately, after the early successes in the clinic with PD-1, and in particular the Keynote and Checkmate studies, led to a gold rush of activity. Thousands of trials, billions of dollars spent, and yet few real transformational breakthroughs have happened since. It's with some irony that Genentech earlier this year took their IO group and merged it back into oncology, and Ira Mellman has left the company. The IO space has indeed been facing real headwinds. Areas that have not in oncology, and some of the areas of excitement, remain radiopharma and ADCs, being able to deliver cancer-killing payloads to tumors. The area of precision oncology has come back, targeting mutant-specific programs. Degraders, like heterobifunctional degraders or molecular glues in this area. And then bispecific T-cell engagers, being able to deliver the power of those cell therapies, but through a T-cell engager. If you note, a number of these are new modalities. Of course, we've talked a lot about the explosion of modalities in the past. This was a figure from the year in reviews of 2016 or 2017, just highlighting this explosion of new drug modalities, this expansion of the toolkit for driving different pharmacologies. We are starting to see real winners and losers shake out. Some of these modalities will have broad applicability, and others will not. Concerns around manufacturing, distribution, and complexity will limit the progress of lots of these modalities. And fundamentally, oral pills remain the preferred modality for delivering medicine to patients. So some of the modalities that are currently of huge promise but still facing headwinds would be things like cell therapies, gene editing, viral gene therapies. Some of the areas that have tailwinds behind them, non-viral delivery, degraders, T-cell engagers, and being able to target therapies with not only ADC and radiopharm, but also things like oligonucleotides to particular tissues like muscle or the brain. Importantly, though, some of the areas that have faced headwinds have actually made great progress through the FDA approval cycles. This year, we're going to see 40 to 60 FDA approvals, right in line with where we've been on the average for the last 10 years, and lots of innovation well represented by new modalities. Casgevy, the first CRISPR gene editing approval for sickle cell. Amtagvi in the tumor-infiltrating lymphocyte space from Iovance. We see lentiviral gene therapies. Importantly, one of the most impactful new drugs is a small molecule. Cobenfy used to be called KarXT, the first new medicine for schizophrenia in over 3 decades. We're particularly excited by the approval of Ojemda at our portfolio company, Day One, working on pediatric brain cancer, a type of cancer called low-grade glioma. We're thrilled to see that drug be brought to patients. Behind this great set of new approvals, we, of course, as we've done in every year in review, polled the team for other areas of excitement across the clinical stage and late-stage pipeline in the industry. One of the most exciting pieces of new data was at WAVE, where they showed that RNA editing in patients can work. Really exciting validation for that platform, one with which we are chasing at KoroBio. I've mentioned B-cell depletion now a couple times, either through CAR-Ts or T-cell engagers. There is so much activity here. There's new news almost every week around this class of medicines. We are certainly excited about seeing those to be brought to not only patients, but eventual approvals. And then in the area of TSLP and immunology, so Tezspire has shown great data in asthma where it's been approved, but Amgen and AZ just showed data in COPD, in emphysema, showing really profound benefits. We're chasing on their heels there with the Aelos product, twice yearly product that GSK recently purchased. In the area of cancer, the menin inhibitors and the KRAS inhibitors, 2 very exciting spaces, contributing real value to those patient populations. And then most recently, in spinal muscular atrophy, the myostatin program at Scholar Rock, really showing surprising efficacy in that space. So lots to be super proud of as an industry. We are also super proud of lots of the clinical activity going on in the Atlas portfolio. So to start Q32 with the IL-7 receptor story, they're going to be publishing data in alopecia and in atopic dermatitis here before the end of the year. We mentioned Kylera in phase 2 in obesity. Importantly, Scorpion as a mutant selective PI3 kinase alpha inhibitor going after breast and ovarian and other cancers. Really tantalizing early clinical data. Vigil going after the genetically validated TREM2 approach, but with both small molecules and an antibody approach, really wanting to win on that important target. And then Sionna bringing forward the first ever MBD1 corrector in cystic fibrosis. While Vertex has done a great job on the other domains of the CFTR, Sionna is bringing the first ever drug that targets where the F508 mutation exists. And then lastly with Remix, a small molecule RNA degrader against a transcription factor known as MIB, showing early and exciting clinical data in AML, MDS, and ACC. So this group is just scratching the surface of some of the exciting stuff going on at Atlas, but not everything works. And it's important every year we celebrate some of the failures. And we had one of our own this year, Aerovate, a very well-conducted study in pulmonary arterial hypertension, unfortunately a very clean negative, and they're exploring strategic options. Pfizer has also faced a few challenges. Oxbryta recently was approved for sickle cell, but unfortunately is being withdrawn due to an imbalance in safety events. Really tragic for the sickle cell community. And then in the Duchenne muscular dystrophy space, their gene therapy for mini-dystrophin, showing great transgene expression, but unfortunately no functional benefit in boys with Duchenne. Verve, bringing gene editing into the cardiovascular space, unfortunately hit some adverse events on the safety side with their first-generation product. Hopefully 102 is able to avoid those issues. And then, as I mentioned, in the immuno-oncology space, some real headwinds there. CD47 and TIGIT really underperforming expectations with relatively lukewarm data in the cancer space. And so these are all specific examples of where folks took calculated risk and the science or medicine just didn't play out. But that should be acknowledged, rewarded, and celebrated. It is really hard to make a medicine. As we boil all this up into the aggregate industry statistics, it becomes even more sobering. The cost to bring a drug to market has gone up over the last decade. The length of time it takes to enroll trials is up 50%. Failure rates remain incredibly low. 1 out of 10, it's gone down over the last decade. Even if up over the last few years, 1 in 10 is still just unacceptable. And then lastly, from a value perspective, the average pipeline value in the top 20 pharma companies today has gone down over the last decade. When you think about these in aggregate, it reinforces the message that not only is this a tough business, but when it works and when we are able to bring a drug to patients, we should be rewarded for the risk-taking with adequate drug pricing, which is a great segue to some of the broader risks that we talked about last year, namely drug pricing, talked about the FTC, the FDA, patents, and interest rates. Although with the recent election, it's likely the FTC's posture will change, there's been no material updates on that, nor on intellectual property. So that's all I'll say about those. But I will add a comment on basic research and the NIH. But let's start with drug pricing. The Biden administration celebrated $6 billion of savings when the new drug prices were announced in August of this year. Unfortunately, for those of us in the space, I think we view this more as political theater. Those savings were done off of list prices, which of course no one ever pays, and only the net price really matters. This is why both Wall Street and pharma companies in their quarterly earnings releases essentially yawned at the prices that were negotiated. But the IRA is not without risks. The longer-term risks remain. This distortion, encouraging complex biologics over oral small molecules, needs to be corrected. The idea that you should have almost all of your indications already in your initial NDA to get approved. There's no reward for adding indications later on in lifecycle management. And then lastly, more and more drugs will have government price setting mechanisms affecting their revenues over time. And so I think this does remain an issue, and I'm hopeful that the new Congress can address this. On the FDA front, the industry really wants a Goldilocks FDA, one that sets a high bar, but yet still supports innovation. I think it's fair to say that the FDA's record around rejections has been reasonably predictable. The number of complete response letters is fairly steady over the last 5 years, predictable level of activity there. But there have been times when the FDA has taken a much looser posture to approvals. Aduhelm failed one of its big phase 3s, missed the primary endpoint, still approved, unfortunately. Drug eventually was taken off the market. And then recently with Elvidis in the Duchenne muscular dystrophy space, drug got approved on the expression of the transgene, but without actually showing functional benefits. The label was expanded to a much wider group of Duchenne boys. I'm super hopeful that the confirmatory trials will show functional benefit in those boys, especially given the multi-million-dollar price tag of that therapy. In the area of basic research, the NIH is between $45 and $50 billion every year. The little downward blip is because the 21st Century Cures Act of 2016 is just coming off. Essentially, $45 to $50 billion is being funded in terms of health research in the United States. 50% of that is in basic research, and that basic research enterprise involves hundreds, if not thousands, of academic labs around the country. Many of those labs are, of course, publishing papers, and the dirty secret in the drug business is that only about 50% of those observations can actually be replicated and reproduced in an industrial setting, raising real questions about the robustness and generalizability of lots of academic findings. In a much smaller slice and much less abundant and frequent than reproducibility challenges is the area of retractions. We are seeing a steady increase in the number of retractions of academic work. And so I think both of these things, a reproducibility issue and the increase of retractions, raise questions about the basic research enterprise in the United States and our need to self-reflect and improve the underlying system. The last area I'd like to talk about is around interest rates. Back in September, the Fed started the pivot to a new regime, dropping interest rates by 50 basis points. The expectation is that we're going to drop about 200 basis points by next summer. This 3% target rate would be very positive for biotech and other loss-making, long-duration, high R&D intensive industries, given that our valuations are based off of very far in the future cash flows. Importantly, this interest rate will also help bring money from the sidelines. Right now, there is money parked in money market funds at all-time high levels. But with lower interest rates, this money will come off the sidelines and back into the equity markets, hopefully providing a positive bid to underpin some of the valuations and stock prices in the market. And so that's a great segue into the overall investment climate. Taking a look at the market context, and then I will go through the 4 C's of the biotech ecosystem: capital, collaboration, community, and culture. On the market context side, just taking a snapshot of the equity indices, if you look at the last 5 years, big tech is up about 150% over that period of time. The S&P 500 is up about 100%, and big healthcare is shortly behind that. Unfortunately, the XBI significantly trails those other equity indices. Over the 3-year time frame, a similar view exists, really catching the downdraft from the pandemic bubble in biotech. Over the last year, biotech is up 10% or so, but of course that's not keeping pace with the 20+% with the S&P 500 and the big tech companies reaching all-time highs. And so while that paints a challenging picture for the overall equity markets, there have been pockets of massive outperformance, and one of those is, of course, in the obesity names. I pick on the obesity 5 here, which would be Lilly and Novo on the pharma side and Amgen, and then 2 big biotechs bigger than $5 billion with Zealand and Viking, both making great progress in obesity. But you can see 93% year to date. That's twice the average that the Magnificent Seven in the tech side has shown this year. And so real striking outperformance and beating other indices as well as the S&P 500. Obesity has really reshaped the pharma industry's league tables. In 2014, you can see by market cap here, the big five that have historically always been the big five. In 2019, the big five didn't really change. Little movement between them, but still the big five are there. But then in 2024, Lilly and Novo hit the top of the charts because of obesity. Lilly in particular wasn't even on the list in 2014. And now you can see a company like Pfizer has moved to the bottom. To put into context Lilly and Novo's incredible value appreciation, if you look at just over the last 3 years, from 2021 until 2024, those two companies alone have added $1 trillion in aggregate market cap. If we compare that to the 700 plus biotech companies that have gone public in the last 25 years, since 2000, you look at the 300 of those that are still trading, they're worth a little over $350 billion. If you then add in all of the M&A of another 300 or so companies, that brings you to just less than $1 trillion. So it's fair to say Lilly and Novo created more value in 3 years than all of the newly minted public companies in biotech for 25 years. Just a staggering amount of value appreciation. But if you think obesity is big, AI and machine learning is even bigger. If you take a look at NVIDIA's market cap, it's essentially equivalent to the top 10 pharmaceutical companies. Just a staggering amount of growth over the last few years. If we make a comparison of these two just for fun, and you look at revenues, they're about $500 billion in revenues across the top 10 players. NVIDIA's is 5 to 10 times smaller than that. And if you look at the number of units sold, the pharma industry sells about, of these top 10 companies, about 500 million prescriptions in the United States with branded drugs. NVIDIA sold 500,000 of its high-end GPU chips that lead to the vast majority of its revenues. So on one hand, you have a sector making drugs that are saving countless millions of lives and making their lives better. And on the other hand, you have a sector making the chips behind Skynet's Terminator. No, but in all seriousness, the tech sector is absolutely enormous, led, of course, here by NVIDIA. The big pharma industry is huge, and I think it puts into context how modest the aggregate biotech sector actually is, which means that small changes in fund flows and sentiment can have dramatic effects on the underlying biotech ecosystem, which is a great segue into the 4 C's of our ecosystem, starting with capital. So if you look at the equity capital markets in the last 10 years, this captures venture capital, IPOs, and follow-on financings. 10 years ago, that was about $5 billion a quarter. Today, that's upwards of $15 billion a quarter. So an increase overall. And you can see the few spikes when the markets got more frothy in 2015, in 2018, and then, of course, the pandemic bubble. And so if we explore these, starting with follow-on financings, here's quarterly numbers. Aggregate dollars flowing into publicly traded biotech companies. The first quarter of this year was actually the second largest quarter of all time. If you look at the first half of the year, it actually beat 2020 by just $1 billion. $27 billion of follow-on financings in the equity markets were done in the first half of this year. So an enormous amount of activity in the space. Many of those were, some of those were opportunistic financings, but many of them were driven off of clinical data and new updates around programs. On the right-hand side, a set of the companies that have raised lots of capital. 2 of those, we're pleased, are Atlas companies, Dyne and Chimera, both tapping the markets twice this year, bringing in well north of $500 million apiece to strengthen their balance sheets and allow them to develop their broader pipelines. On the IPO fronts, things have gotten better in 2024 from where they were in 2022 when things really hit rock bottom, as you can see on this chart. So there are some green shoots, 17 or 18 IPOs so far this year, but we are definitely trailing the 10 to 15 IPOs per quarter that we were seeing on average for much of the last 10 years. Companies are being able to go out and raise significant amounts of capital, though. On the right-hand side, you can see these aren't small IPOs. In fact, they're being done at reasonably strong valuations. The median IPO pre-money valuation is still north of $450 million. That's up threefold over where we were just 10 years ago. and is within plus or minus 10% of the all-time highs during the pandemic bubble. But a big difference is these valuations today are being underpinned by clinical stage assets, phase 2, phase 3 programs in particular. That's probably what has led to a reasonably attractive post-market aftermarket performance. Roughly 60% or 2/3 of the companies have been trading up after their IPOs. You would expect to see this kind of dispersion in the public markets in a healthy market, and indeed that's what we're seeing. One of the challenges to a tight IPO market like this is the logjam of private companies. A Lyric analysis suggests that there's 125 or more companies that have raised late-stage or crossover financings and are essentially looking to go public at some point. Of course, many of these may have filed confidential S1s, and we're going to hear from them in 2025, presumably. A number of them are looking at reverse mergers into fallen public companies or seeking M&A partners and such. But the reality is a lot of these, probably the majority, will have to go back and tap and refinance in the private markets at potentially challenging valuations. And so what does that private market look like? The private market in venture capital overall has normalized to sort of $6 to $8 billion a quarter over the last handful of quarters. We think this is probably the new normal. It's 3 times the amount of funding that we were getting per quarter earlier in a decade ago, but it's still well off of where we were during the pandemic bubble. This comes from a lot of traditional VCs, but there remains significant activity from other asset managers, alternative sovereign wealth funds, even family offices still participating. Importantly, as a whole, later stage investors are driving stock terms being shifted towards those late stage preferred investors, in particular around valuations. 50% of the rounds that closed this year were essentially flat or down rounds. The other aspect to this market is it's very much a have or have-nots. The rise of these gigantic mega rounds north of $100 million of financing, it used to be, 10 years ago, these were eye-popping and you didn't see many. Now we're seeing over 25 financings every quarter that are north of $100 million in the biotech space, and 5 or so that are north of $200 million in each financing. So huge amounts of capital concentrated in a small number of companies. To put that in perspective, 10 years ago, couple percentage points of deals were in this mega round area, and it represented 25% or so of the aggregate funding. Today, while it's 15% or so of the aggregate number of deals, it's something like 65% of the overall funding level. So a real concentration into a much smaller number of players. I tried to come up with a Gini coefficient to look at sort of the fundraising inequality across the sector. The best I could come up with was looking at the skew in a distribution. So if you take the mean minus the median, you can come up with how far to the right does the market actually skew in terms of really large but few transactions. It'll pull the average way up above the median. Here's looking at that over 10 years. It is the largest ever spread we've ever seen between the average and median, really emphasizing that concentration of capital in fewer players overall. An area where we're also seeing have and have-nots and some large financings is on the venture creation side of things. And so you'll note that the financing numbers in recent quarters are actually quite high. Those are driven by a few outlier-sized financings, like the $1 billion that Xera raised in the second quarter of this year. I think the most interesting number is where the white line is in terms of total numbers of companies that are being created and tapping into the financing markets for the first time. This is the number is about 60 right now. That's in line with where we were 10 years ago. So real slowing and more discipline in the venture creation space. And I think that overall is a very healthy retrenchment of the ecosystem, where we're going to concentrate early stage talent, capital, and science into fewer companies. Of course, the equity side of these things and starting money with venture capital is only one part of the ecosystem, and a really important part of funding all of this is through collaborations. And to highlight the nature of the ecosystem, here just to look at the share of regulatory filings in the industry where the originator was not a large company. Small emerging biotechs represent nearly 3 of every 4 new drug approvals as the source of those innovations. And then if you take a look at the top 20 pipelines, about half of the pipeline's value, projected value, is actually from externally sourced assets. And so it's clear external innovation remains a huge driver of R&D success in the pharmaceutical space. Most players are very active in finding selective partnering and licensing deals to do. On the licensing front, the aggregate numbers have come off a bit from where they were a few years ago. In terms of numbers of deals, it's probably off 50 or 60%, down to around 400 deals this year in 2024. But the dollar values are well up from where they were a decade ago. So large amounts, upfronts, and biobucks in particular are still robust. On the M&A side, big drug makers this year have been looking for bolt-on acquisitions. This actually was such an important theme that it hit the cover of the business section of the Wall Street Journal, where they highlighted in 5 of the last 6 years, all the deals were in the double-digit, all the biggest deals were in the double-digit billions, the biggest of which, of course, being Celgene's acquisition by BMS in 2019. This year, the biggest has been below $5 billion, and so really highlighting perhaps some of the concern around the FTC in getting deals approved, but in particular, the interest of the bigger players for bolt-on acquisitions. If we look deeper at just R&D stage public biotech M&A, that's really slowed down here in 2024. A number of the recent deals here on the table on the right, but that has come down significantly from its sort of 30 billion-ish run rate for much of the last decade. We're going to be shy of that here this year unless the fourth quarter really picks up. On the private side, we've actually seen a reasonably steady amount of private M&A, $10 to $12 billion of deal activity, 25 or so deals bigger than 100 million. So real activity in the space. Nice table of 12 of the largest deals there on the right-hand side. Atlas, as I mentioned, was happy to participate here with Ilos in particular, as well as Mariana Oncology, our radiopharm company that was picked up by Novartis. Interestingly, of these 12, only 2 of them are preclinical stage stories. So 1 out of 6, suggesting that pharma, while interested in clinical assets, is still engaged on the preclinical side. And then only 2 of these are actually small molecules. Jana and Escient that Insight picked up. Those are the only 2 small molecules. Hopefully not an indicator of the impact of some of that distortion in the IRA, but certainly the potential and promise of lots of these more complex biologic therapies. In particular, a number of these are bispecific or trispecific approaches. And so what do we think about M&A going forward? Look, the firepower behind big pharma companies and big biotech companies is enormous, both in terms of their cash position or their debt capacity. So there's a lot of deals that could happen here. With the changing regime likely at the FTC going into 2025, I think we'll see a lot more overall M&A activity. Our partners in the collaborative side are really an important contribution, but so is the community that we build biotech companies in, and the community starts with people. So taking a look again at turnover rates of employees in biotech companies, call your attention to the white bars. This is facilitated turnovers, often driven by restructurings. We've seen over 300 restructurings done since the beginning of 2023, so the sector very much retrenching. But that number of 10% turnover rate across the industry is the highest we've ever seen it in terms of facilitated turnover of biotech employees. The green bar, which represents the voluntary turnover of folks moving because they're getting poached to better opportunities or finding promotions elsewhere, that's also the smallest that it's ever been. And so we're really seeing those numbers combined suggest a cooling of the overall market and some real belt tightening on the part of companies. We're seeing that in other aspects of the community as well. On the real estate side, overall lab demand, GMP manufacturing demand, both are well off. If you're a new tenant looking for space, it's actually the most tenant favorable period of time, probably in the last 20 years. Our friends in the banking and analyst community have also had to belt tighten their fees, transaction fees from either M&A or the capital markets are down some 40%. So really a survival of the fittest going on with the best banking and analyst teams. And then on the financial services side, so whether you're doing, IPO readiness planning or audits and those kinds of things, the expectation is those revenues are down probably 25% or so. And so everybody is having to react to the post-pandemic retrenchment around being more conservative and belt-tightening. And the changes that pandemic has happened to the industry and the community are really profound. The changes are also profound on how we work. And I think this is the culture piece I'd like to emphasize. Our friend and venture advisor, John Maraganore, former CEO of Alnylam, has a strong point of view on this, a very well-written blog post last year about biotech needing to get back into the office and back into the lab in person, because if you're going to make transformative medicines, you can't really do it from a virtual workplace. The reality is that's not showing up in the numbers yet. Roughly 50% of life science employees across the country are only spending a couple days or so in the office each week, and so really missing out on the serendipity of the meetings in the office and the sort of interpersonal sparks that drive innovation. We're not the only sector, of course, to deal with this challenge. Amazon and others, Starbucks more recently, have also had this issue. And so I think a key question for us is what's going to be the future of work in biotech, and how do we drive the right kind of high-performance culture and innovative culture going forward? And so that's a wrap on the 4 C's of the ecosystem. I just want to have a quick summary of what does all this mean for venture capital as a whole. Venture capital funds have actually raised quite a lot of capital this year, working on $25 billion or so of new funds, 40-ish or so funds have raised. There's been some very large ones from some of our peers in the space. But certainly if you look at the green bars in terms of aggregate capital from LPs going into venture funds, it is a massive difference than where we were 10 years ago when things were much, much more challenging. So you would think biotech as a share of venture has gone up, but in fact, we've been almost constant over this period of time, suggesting that LPs, limited partners, have been pouring money into lots of tech venture capital over that period of time, and biotech has essentially always remained in that 12 to 14% range. Really striking statistic given the change in absolute funding coming through. What does all this funding coming into venture capital mean for returns? The reality is at the median, so taking a look at all funds at the median in the healthcare space, the returns have definitely softened over the last year through March of 2024 against the XBI and the Russell 2000. They still remain attractive over longer time horizons, in particular at 5 years. But importantly, the top quartile funds have really outperformed even over 1 year and 5 years, and very significantly over 5 years relative to the other equity markets. And so it really does come down to manager selection always being an important driver of value in the venture business. I think that's a good time to segue then to a quick update on Atlas Venture and using the view of the last 10 years. I thought it would be interesting to see how things have changed at Atlas. It was in 2014 that we split with our tech partners, moved into new space there in Kendall Square and raised Fund 10. Of course, 11, 12 coming in behind it, our opportunity funds we started to raise in 2019, moved across the street in Kendall Square, but a lot of overall activity happening here. To give you a sense of how much change has occurred, just a set of statistics here. The number of existing active portfolio companies, we now have 56 active companies. That's about twice what we had 10 years ago. Our current Fund 13, is $450 million purely into biotech. We were 50% of 265, so capital is up some threefold for us to be able to deploy. And new companies that we create or that we fund is up just incrementally over where we were before, suggesting we're able to put lots more capital into the deals as they grow and mature over time, and that's certainly borne out in the data here. And then probably the most relevant statistic for driving returns in venture, if we look at the amount realized from active portfolio companies in terms of harvesting either exits on the public markets or M&A, that's up 10 to 15-fold, over $1 billion of realizations in the last couple of years. So a really exciting decade for us overall. An important part of this has been the team, and two of us are celebrating 1 decade as general partners at Atlas. So I call attention to Jason Rhodes, who joined us from Epizyme, and Dave Grazel, who was an entrepreneur and executive with us and became a GP also in 2014. So thrilled to have them. And then another big milestone for Jean-Francois, celebrating over 30 years with us and a bunch of great deals. JF was a pioneer in areas like functional genomics, human genetics, combinatorial chemistry back in the 90s, and subsequently has invested in just numerous great and successful companies, including Intellia in the CRISPR space and Translate Bio in the mRNA world. So JF, super successful. For me personally, he has been a great mentor, a great partner, and a great friend over the last couple decades. JF, while he's not going anywhere, is going to continue to be actively involved at Atlas. He's not going to be making new investments in the upcoming fund, Fund 14. And so as we wrap up the rest of the partnership with Kevin and Michael, the deep bench of talent we have, I have to say I've never been more pleased with how many incredibly bright and talented team members we have here. It's really a fantastic investment team, supported by an equally fantastic operations team led by Omer Chauhan, our CFO. Really a privilege to work with all of these incredible people. So what have we all been doing? Well, we've built a portfolio, a mini pharma company, so to speak, of about 150 programs over those 56 companies. You can see, about 50 of those are currently in the clinic. And so it's almost every week that we're getting some version of clinical data at the partnership level. Super exciting whenever that happens. And then in terms of therapeutic areas and modalities, as I said in the past, we are truly agnostic. In a science-first sense, we invest in all disease areas and all modalities across the board, really wherever the science takes us. We also like to have some diversification on our business models. So we do big platform companies, but we also do sort of single asset or program product-specific investments as well. Capital intensity tends to be very different. They're different in their reliance on fixed infrastructure versus virtual. Their correlation with open public capital markets in particular is very different, but you can generate great returns up and down this continuum. Our analysis always shows that we're able to generate, I think, differentiated returns on both sides of this long continuum. There's been lots of excitement in our portfolio in 2024. I mentioned a few of the M&A exits. We've done over 20 private financings, some of them disclosed here in existing companies, but another 10 or so done in stealth mode seed stage companies. On the public side, lots of financings and activity there, as well as a lot of new clinical data across the range of Atlas companies. So it's been a super busy and exciting year. One of the things that we've been recently focused on is Fund 14, and I'd just like to highlight it. The key theme here is disciplined. And so we've chosen to actually come to market with the exact same size fund as we raised in Fund 13, $450 million. This was the product of a deep strategic and analytical review of how do you generate outsized returns with our strategy. And we have a lot of conviction that this is the right fund size for us. We're also disciplined on our focus, not drifting from what we know and what we enjoy doing, which is venture creation as the vast majority of the deals that we help put together. And then lastly, around firm evolution, we haven't grown or expanded or extended and gotten out over our skis with organizational growth or complexity. And so disciplined approach to Fund 14 is very much the focus. I'd just like to close out with a reminder of the core tenets, and staying disciplined to our core tenets is a big part of our strategy. I mentioned seed-led venture creation as being the focus. We're really science-first investors. We find that science globally, and we end up building most of those companies locally with us. We're purely in the therapeutic space, and so no drift into other areas of healthcare. And then lastly, and most importantly, we aspire to do well by doing good. If we can drive impact and value for patients, returns will come. And so with that, I'd like to conclude this year's 2024 year in review. Thank you very much.